Hi, my name is Furqan Warsi and I am a fellow member of the Institute of Chartered Accountants of India. I am here to discuss with you all the provisions relating to International Accounting Standard 18 revenue. It's my pleasure to have with me Mr. Abhishek Asthana, a fellow member of the Institute of Chartered Accountants of India and a very renowned faculty and author on financial accounting and reporting. In addition to IS 18, we will also discuss the accounting treatment required under IFRIC 13 Customer Royalty Program. Today, in our discussion, Mr. Abhishek Asthana will also examine the revenue recognition policies adopted by some renowned companies. Abhishek, my first question is IS 18 the only guidance under IFRS for revenue recognition?
Thanks, Furqan. If we see the entire structure of IFRS, you will find that there are more than one standard which speaks about revenue recognition. IS 18 deals with revenue arising from sale of goods, from rendering of services and interest, royalty or dividend. If I am selling a product, then I will recognize the revenue in accordance with IS 18. Similarly, if I am providing the services, I will recognize as per IS 18. Further, any income from interest, royalty and dividend will be recognized as per IS 18. However, revenue arising from following transactions will not be governed as per IS 18. IS 17, any income arising into a lease arrangement to a lessee, income arising to a contractor under construction contracts, relating to the transactions of IFRS 6, relating to the transactions of IFRS 4 and fair value changes of financial instruments, investment properties and agricultural assets. Any lease rental income arising in course of a lease arrangement to lessor is not covered by IS 18. IS 17 provides a guidance.
Abhishek, for recognizing the revenue, we need to determine two things. One, the amount at which we will record the transaction, that is the measurement concept. Second, the time at which we will record the transaction, that is the recognition concept. Let's discuss the measurement concept. As per my understanding, IS 18 says that revenue shall be recognized at the fair value of the consideration received or receivable. And further, fair value have been defined as an amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties at an arm's length transaction, that is the market price. Now Abhishek, how this concept of measuring the revenue at fair value under IFRS is different from our existing practice of measuring the revenue at nominal value?
Furqan, let's see the impact of fair value of consideration over current practices of revenue recognition. See, any transaction of revenue can either be a cash sale or a credit sale or a barter transactions where goods are exchanged for goods. We will discuss the barter transaction into later part of our discussion, but right now we will discuss the impact of fair value of consideration over cash sales and credit sales. Furqan, through the following working, I will try to explain the impact of fair value of consideration. Let's take case 1 where I am selling on cash. If I am selling the goods for cash, then fair value of consideration is equal to cash price, hence no impact. Furqan, in case of credit sales, two situations can possibly arise. One, that I am selling the goods on credit and cash price is available. Other, that cash price is not at all available and I am selling the goods on credit. Let's examine the scenario first where I am selling the goods on credit and cash price is available. In the present scenario, the credit period is 2 years. Now let's assume that the cash price of the product is 165 rupees and the credit sale price is 200 rupees. In the present case, the fair value of consideration will be cash price, that is 165 rupees. Now the question arises, what will happen to the difference between transaction value, that is 200 rupees, and cash price 165 rupees. This difference will be treated as interest income. Another problem that might arise is how to allocate this interest income over the credit period. To do that, I need to calculate imputed rate of interest. Imputed rate of interest is the discount rate at which present value of transaction price, that is 200 rupees, will be equal to cash price, or I can say present value of transaction price is equal to fair value of consideration. In the present case, if I am going to calculate it, this is equal to roughly 10%. Now, how I will arrive at interest income for year 1? I will take the cash price multiplied by discount rate, and I will have my interest income for year 1. Now, let us see the journal entries which I am going to pass in year 1. First entry will be the sales, and I will record, as you can see, the sales will be recorded at cash price, that is the fair value of consideration. Apart from this, I will recognize the interest income for year 1, and I will transfer this interest income to profit and loss account.
I have a question here, Abhishek. When we are going to recognize this interest income, shall we recognize it on a quarterly basis or a half yearly basis or on a yearly basis? Is there any guidance given in ISAT?
You have an option that you can recognize the income on monthly basis or a quarterly basis or an annually basis. For the sake of convenience, I have taken in this example that interest income is recognized on an annual basis.
Oh.
Now, what will be the position of my debtors? Well, debtors are going to be the cash price plus the interest income for the year 1. This will be the closing balance of debtors at the end of year 1 arising out of that sale. Now, for the year 2, the interest income is going to be the opening balance of debtors multiplied by discount rate, and this is going to be my interest income for the year 2. And in the year 2, I will pass the following entries. First, I will recognize the interest income, then I will transfer that interest income to profit and loss account. What will be the value of debtors at the year end 2? Well, that is going to be the opening balance at the year end 1 plus the interest income at the second year, and this is the total balance. You can see that this is equal to the transaction price now, and I will settle this transaction at the year end 2 by receiving the payment. Furkan, now we will consider the scenario 2 where I am making the credit sales and cash price is not available. Like you can see that the cash price is not available in the present case, and the sale price for a 2-year credit is rupees 200. How I will arrive at the fair value of consideration? In the present case, fair value of consideration will be equal to present value of this transaction price, that is the present value of 200 rupees. And immediately a question arises, how I will present value this? To arrive at the present value, I need to calculate the imputed rate of interest. But here in this case, imputed rate of interest source changes. In the former case, it was the discount rate at which the transaction price present value is equal to the cash price. But here the source gets changed because cash price is not available, and imputed rate is market rate of return for a issuer with a similar credit rating. Let us assume that the imputed rate of return in this transaction for say A Limited is 15%. Now, I will present value that 200 rupees, which is the sale price on a 2-year credit, at 15% and arrive at my fair value of consideration. But again the same question arises, what will happen to the difference? The difference between the present value of transaction price and the transaction price itself. The answer is that this will be treated as interest income. Furkan, let's see the journal entries which we will pass at the end of year 1. First, I will record my sales at the fair value of consideration, and you can see that this is different from transaction price. Other, that I will recognize the interest income which my debtors have earned, and third, I will pass this income to profit and loss account. Now, what will be the position of my debtors at the end of year 1? Opening balance, that is fair value of consideration, plus the interest income, this is the closing balance. Now, let us see what will happen in the year 2. First, the interest income, which will be the opening balance for year 2 multiplied by imputed rate of interest, and this is the interest income for year 2. Now, let us see what are the journal entries which I will pass into year 2. First, recognition of interest income. Second, transfer of interest income to profit and loss account, and my closing balance is going to be again equal to transaction price. Opening balance at the end of year 2 plus interest for the year is equal to transaction price, which I have recognized through sale as a collection from debtors.
I understand that, Abhishek. In both the cases we have seen that the seller has recognized its revenue at the fair value, that is 165 in the first case and 151 rupees in the second case.
Right.
What about purchaser? How he is going to record the transaction? Will he record it at 200 in both the cases or at 165, and how he will do the process?
Furkan, if you see the requirements of IS2 which deals with inventory, we will find that IS2 prescribes the same treatment for purchaser also. The purchaser will record the transaction at 165 rupees, that is the cash price of transaction, and interest expense for the first year. Again, since the credit period is 2 years, then he will also recognize the interest expense for the year 2, and at the end of the second year he will make the payment, which will be equal to the transaction price, that is 200 rupees.
So Abhishek, in this case there will be no issue of reconciliation between the books of the seller as well as the book of the purchaser.
Absolutely.
Abhishek, I understand that. Now I have a question that in both the scenarios you have taken a credit period of 2 years.
Right.
Am I supposed to do the entire exercise even if my credit period is very small, say of 15 days or 20 days, which is normally termed as normal credit period?
Furkan, conceptually speaking, you are required to do that. IS 18 is not saying that if the credit period is long you do that, and if credit period is short you don't do that. But IS 1 says that you apply the IFRS only to the material items. And here in this case, if I am going to present value a credit period of 15 days or 20 days case, then it is an immaterial item in most of the cases. If it is an immaterial item, then IS 1 says that you are not required to follow the present value concept, and I can still take the transaction price as the cash price if the credit period is small, like 10, 15 or 30 days.
Abhishek, if I understood correctly, then the following impacts will be there on my books. First, the entire revenue will be divided into 2 parts. One will be from sale of goods. In our first case it was 165. The balance 35 will be my interest revenue. Second, this interest revenue is being recognized in the second year, some part of it. One part is recognized in the current year and some part is even shifted to the next year. Further to that, we are not just only recognizing the sales are at fair value, but we are also keeping our debtors at fair value at the time of recognizing this sale.
Yes, you have got it absolutely right, Furkan.
Abhishek, we have seen the impact of the fair value measurement on cash sales as well as on credit sales. Now, what is the impact of fair value measurement on barter transaction?
Furkan, when the goods are swapped for goods of similar nature and value, that is with the same goods, then as per IS 18 there is no sale and therefore revenue should not be recognized. Normally this happens in milk and oil industry. To meet the demand, one organization delivers stock at one location and receives the stock at another location of same nature and value. For example, if entity A delivers 2000 liter of milk to entity B at one location and as a consideration receives 2000 liter of milk from entity B at second location, then as per IS 18 it is not a sale and therefore revenue should not be recognized. However, if the goods of different nature and value are being swapped, then IS 18 says that it is a sale. Now the question arises that what will be the consideration at which the revenue will be recognized? The answer is same. Consideration will be the fair value of the goods received. Let us take up an example. Suppose Mr. A manufactures car. Sale price of car is say 2000 currency units. It sold a car to Mr. B who is manufacturing motorbike, and as a consideration for sale is receiving 4 motorbikes. Sale price of 4 motorbikes is 2100 currency units. In this case, the revenue to be recognized for sale of car by Mr. A is 2100 currency units, that is the fair value of consideration of goods received. Further, IS 18 says that when fair value of the goods received cannot be measured reliably, then the fair value of goods given up can be taken. So, in this example, if we are unable to calculate the fair value of bike, then we can take the fair value of car as my consideration for sale of goods.
Abhishek, before moving to the recognition criteria set out in IS 18, let's first discuss other important points relating to revenue and discussed in IS 18, such as trade and volume discount, separately identifiable components, we normally term it as bundle contract, and linked transaction. So, IS 18 says that any trade discount or volume rebate has to be taken into consideration. Please elaborate this.
Furkan, actually the 3 things which you have mentioned are related to measurement, and these are something which are very critical to the revenue recognition. And first I will like to take the trade and volume discount, and through the following working I will explain how to account for trade and volume discount. Furkan, as far as rebates and discounts are concerned, I would like to segregate my discussion into 4 parts: trade discounts, settlement discounts, volume discounts and bad debts. So let us start with trade discount, and I would like to take this sample transaction where 100 liter of a product is sold at 900 rupees a liter, where the price is actually 1000 rupees a liter, and this is simply a trade discount because I am purchasing in bulk at 0 point of time. Now this discount is accurately determinable at the time of making the invoice, so no estimation is required. So I will deduct it while making the recognition of revenue, mean to say revenue will be recognized on net basis rather than on gross basis, and this journal entry will be passed at the time of initial recognition of revenue by debiting the debtors, crediting the sales with 90,000 rupees.
So you mean to say that we will not take the sales at rupees 1000 at first instance and put the discount of 100 rupees into my P&L account. Instead, we will take the sale price as 900 rupees from 0 point of time.
Absolutely correct. Furkan, now we will discuss settlement discount. Let us take the sample transaction where A Limited has sold 100 liter of product at 1000 rupees per liter price. Now, what are the terms of discount? 2% if purchaser is paying within 15 days, and no discount if you are paying beyond 15 days, but stipulated period maximum possible is 30 days. That is the limit given by the buyer. Now these kind of discounts are requiring a estimation for recognition of revenue, because I am not sure that whether that is going to be received within 15 days or not. I need to estimate based on the prevailing practices, previous history of that purchaser, industry practices for the similar products, what is your credit history relating to other buyers, you have to estimate. Now those estimations are required. So in this settlement discount case, that estimation of the fact whether the discount will be availed or not be made at 0 point of time, that is at the time of initial recognition of revenue. Hence, that will be deducted on initial recognition time, and revenue recognition will be on net basis. Again want to remind that even if I have estimated the discount amount, is still the revenue recognition is going to be on net basis, and this entry I will pass assuming or estimating, I should say, that the buyer will avail the 2% discount by paying within stipulated 15 days period. Two situations can arise. One, he has paid as we have estimated, then not a problem, bank account will be debited and payment will be received equivalent to 98,000, means 2% discount is allowed. Other possibility is that he has failed to pay within the stipulated period of 15 days. Then am I going to recorrect my revenue? The answer is no. That 2000 rupees will be recognized as interest income rather than correcting my revenue again, and debtors will be increased and I will recognize a lakh rupees instead of 98,000 rupees. So this is the settlement discount, how I am going to deal with this. In the books, at the time of initial recognition, at the time of subsequently receiving the payment, or any change in my estimate. These are the general entries that are required to be passed. Now Furkan, let's consider the scenario of bad debts, where no discount policy is stipulated actually. Only the transaction is that 100 liter of product is sold by A Limited at 1000 rupees a liter. Hence, in the present case, I have no discount. But only thing that is that please pay within 15 days. Hence, no estimation or accuracy of discount is required to be there. So, no deduction from the invoice price, that current invoice price is a lakh rupees. Revenue recognition in this case is going to be at gross value, that is a lakh rupees, and this journal entry I will pass at the time of initial recognition. Debtors debited to sales account with a lakh rupees. Now two possibilities can be here. One, customer has paid as stipulated. If that is happening, then payment is received from the debtor and account is settled. If the customer not paying as stipulated and only 90,000 is received in full and final settlement, then the difference 10,000 will be debited to bad debt account and later on will be transferred to the profit and loss account. This is the accounting treatment in case where no discount policy and customer is paying as stipulated or falling short of paying from the stipulated terms. So the difference, if arising at all, will be debited to bad debt account. Furkan, now let's discuss the volume discount. Volume discount is normally a practice where a buyer is making multiple purchases during a particular period. Now, in order to encourage the buying, a slab of discount is offered to that buyer. Again, the transaction is similar, that 100 liter of product is sold at 1000 rupees per liter. Now, let us see the terms of discount. up to 100 liter of purchases, 5% discount is offered. But if the buyer is purchasing anything between 100 liters and 300 liters, then 10% discount is offered on entire purchases made. Further, if he is purchasing anything between 300 and 400 liters, then on the entire purchases, 15% discount shall be awarded. And if he is purchasing more than 400 liters, then 20% discount shall be given to entire purchases made by that buyer. These are the terms for volume discount which are given by A Limited to one of its buyer. Now, it is anticipated that multiple purchases are going to take place. First purchase was in January. Quantity 100 liter and gross sale value is a lakh rupees. Volume discount according to the current slab is going to be 5%, which is awarded, and net value is 95,000. Now this is the amount which I will consider for initial recognition of revenue. Mean to say, netting off of revenue will be done for the volume discount, and following entry will be passed.
The scenario here is same to the one which we discussed initially in discussion on volume discount.
Right. Now, come again, since multiple purchases are expected from that buyer, second purchase is taking place in July of 200 liters. Gross value is this much. Discount. Now, he is falling in the second slab. So, a discount which is going to be awarded is 10% for that 200 liter itself. And the net value is 1,80,000 in this case, for which I am going to pass this entry. Right? Again, take the example that a third purchase is taking place in December of 100 liters. Now this 100 liter is falling under third category. For this specific 100 liter, the discount which will be given on invoice is at the rate of 15%. So 15% discount is offered, which is 15,000, netting off is 85,000, and this is the revenue entry. But what will happen that at the end of financial year, when I'll say that the terms are saying if a particular slab is achieved, then not only on the sales of that slab, but to the entire sales, additional discount is required to be given. How that is going to be calculated? Now my maximum slab that is achieved is 15%. But on first 100 liters, I have given a discount of only 5%. That's why additional 10% of discount shall be awarded. How that will be awarded? By adjusting it to revenue. That's an important point to understand, that adjustment will take place against revenue. Similarly, I'll go for the second slab, for which I have already given a 10% of discount, but since based on that 100 liter which have been purchased in December, now the buyer is entitled to 15% of discount, hence additional 5% is awarded to that buyer. And as we have discussed, this is going to be adjusted in revenue.
I have a question here, Abhishek. We are passing this entry when we are going for a second sale of 2 lakh units, or we are passing this entry at the end of the year?
Purgan, if this volume discount scheme is pertaining to my financial year only, then these journal entries are the final entries and the impact is settled. But sometimes a volume discount scheme, either because the financial year differential, means my financial year is different from the buyer's financial year, or because the volume discount scheme is for more than 1 year, say 2 years, then if the volume discount scheme is extending beyond my financial year, then in addition to what we have done earlier, adjusting it for the final slab what we have achieved, the discounts, we have to do some more workings on estimated basis. One, Two situations can arise. One is no further sale is expected. Even if the volume discount scheme is extending further, no further sale is expected. If this is the scenario, the transaction is settled. But if the situation that further sales are expected, like in this case I am assuming that 200 liters can be sold in year 2 as well. In this case, at the year end 1, following additional entries shall be passed. That is, make a provision out of profit and loss account for the discount which might arise if these 200 liters are going to be sold.
It is basically based on my estimate that further purchases will be made.
Right.
And I'll be bound to provide the discount on existing purchases.
Right. This 50,000 is for 100 liter purchase, and this is the additional for 200 liter purchase, and this is for 3rd December purchase. These are the 3 adjustment entries which I am required to pass at the balance sheet date as a estimation. If the volume discount scheme is not settling at the end of financial year. Two things I want to highlight out of the entire discussion. One, volume discount is going to be netted against revenue if according to the slab the rate is settled. If I am falling under a 5% slab that is settled, then discount will be on invoice and it will be deducted out of revenue. At the end of the year, again settled, but that was not given on the invoice, settle it against revenue. If a scheme is going to be extended and sales are not taking place, but it is expected that that might take place into the future, then provision will be made out of profit and loss account. This is the entire discussion which sums up a volume discount rebate accounting.
Thank you, Abhishek. Abhishek, IS 18 also requires that when two transactions are linked in such a way that we cannot record the substance of the transaction unless and until we treat it as a single transaction. So could you please elaborate this and give an example on this?
Yes, Furkan. Suppose an entity may sell goods and at the same time enter into a separate agreement to repurchase the goods at a later date, thus negating the substantive effect of the transaction. In such a case, the two transactions are dealt with together. Let's take up an example. The management of entity A is considering the following transactions: sale of inventory to a bank for $5 lakh with an option to purchase the inventory at any time within 24 months from the date of sale. The repurchase price is $5 lakh plus an imputed financing cost, that is 10% per annum. The bank is required to provide substantially the same quality and quantity of inventory as was sold to it. That is, the bank is not required to return precisely the same physical inventory as was originally sold to it. The fair value of inventory sold to the bank is $10 lakh. Now, in these type of cases, friends, we can record the transaction in two ways. First, record it as a normal sale and then as a normal repurchase. But IS 18 restricts you from doing this treatment. IS 18 requires you to look into the substance of transaction rather than in form. If you see the substance of transaction, it's not a normal sale. In fact, this is a transaction in which entity A is taking loan of $5 lakh from a bank at an interest rate of 10% per annum. How we conclude this? First, the transaction is with the bank. Second, fair value of inventory is $10 lakh, whereas it has been given to the bank for $5 lakh. Third, the option to purchase the inventory was given. Fourth, the repurchase it at transfer price plus market rate of interest. And fifth, the bank is required to provide substantially the same quality and quantity of inventory as was sold to it. Now the question arises, how should management record the transaction? Management should not recognize the revenue unless and until repurchases allows an option to lapse. The inventory should remain on entity's A balance sheet and proceeds recognized as a collateralized borrowing until entity's A right to repurchase the inventory lapses. Entity A is unlikely to let the repurchase option lapse as the enforced sale was not significantly below the fair value. So, at the time of sale, I'll debit bank account with $5 lakh and liabilities, say borrowings, will be credited with the same amount. And at the end of year 1, entity A will recognize interest cost at the rate of 10%. Interest expense debit $50,000 and liabilities are credited with $50,000. At the end of year 2, entity will recognize the interest cost again following the same entry, and the total borrowings will be repaid at the end of the year 2 in form of returns. Suppose at the end of second year, entity A repurchased the asset, then the following journal entry will be passed. Liabilities will be considered as paid, hence the liability account will be debited with $5 lakh initial borrowings plus $1 lakh as the interest for 2 years, and the cash account or bank account will be credited with $6 lakhs. This is the treatment which IS 18 suggests if a transaction is a linked transaction.
Thanks Abhishek for touching the finer aspects of IS 18 revenue. Thank you.
It's always my pleasure. Thank you, Furkan.